You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. I hope that you are doing well. Are there penalties for accessing your policy cash value? I thought I would touch on this topic more today. I know I've mentioned it in the past a little bit or touched on it, but I do have some fresh information, different information, so don't fret. But when it comes to life insurance, whole life insurance, are there penalties to access my cash value? Will there be a penalty if I'm not 59.5, or will there be required distributions, minimum distributions? Are there surrender charges? No, there's not with whole life insurance. There are no surrender charges like there are with index universal life policies, which I've mentioned before. There are no RMDs, required minimum distributions, like there are with qualified plans such as IRAs or 401ks. Although, side note, if you do end up causing your policy to become a modified endowment contract by funding too much cash into the policy over and above the cost of the policy, then yes, it would start to have rules much like a retirement plan or qualified plan, and you would have the 10% penalty if you were to pull cash out earnings and you're not 59.5 yet. Then you would have that with a modified endowment contract. So just another reason to protect against your policy becoming that. You want to be careful. You want to build a sturdy policy or have a sturdy policy built for you. Now, what about for a retirement plan, a qualified retirement plan? Will there be penalties or fees when you're accessing your retirement plan? Yes, if you're under 59.5, which I know most of you all know, there's a 10% penalty if you're trying to access your IRA or 401k under 59.5. And there also will be required minimum distributions if you are over age 73. Another thing to keep in mind is that there will also be tax due when you pull money out of those retirement plans. I talk to people all the time, and sometimes people think that that money will not be taxable so long as they wait till their retirement years or until they're over 59.5 to access that money. But no, it is still taxable because you haven't paid tax on it yet. And the government has been waiting for a very long time. They are ready to receive their tax money. So unless your account is a Roth account, you will have to pay tax on any amount of the withdrawal because it's all taxable. It has not yet been taxed. If you have a Roth account, a Roth IRA, you can access those income tax free. So long as you've had your account for over 5 years, you can access the earnings tax free as well. Otherwise, you have to wait to access the earnings for it not to be taxable if it's been under 5 years. Okay, here's a fun little exercise, or an exercise I thought would be fun. If you were to get out your retirement account statement and look at the balance. Now, you may or may not feel great about the balance right now that is in your account. Let's just say it said $100,000. You have $100,000 in your retirement account. Let's just say it's an IRA. But is that really your account value, what you're looking at? When you look at the $100,000 balance, is that what you have? Is that your money? Because when we look at that, we feel good. Okay, that's my money. That's what I have for retirement. That's what I have to access later. But you have to keep in mind that Uncle Sam's tax money is wrapped into that. So that balance that you're looking at is not all your money, because when you start to make those withdrawals, you will have to give Uncle Sam his portion that he's been waiting patiently around for all this time. It actually would probably be nice if they would break down the statement into two parts. The part of the money, or show the value of the money that's yours, and the value of the money that's theirs, Uncle Sam's value, what he's going to receive when you pull your money out. So take a look at your statement again and subtract out the amount of tax that you project you will have to pay. Now that's what your statement should say. And we don't even know what share of the money will actually end up being yours, because we don't know what the tax rate will be at the time of your retirement, at the time you actually start withdrawing this money. And with all of the enormous needs of our government, you could be at a 50% tax bracket. I know that's scary and sounds like totally impossible and like it could never happen. But actually, for over 60 years of our income tax paying history, taxes have been over 50% for the highest income earners. And then, of course, they just scale down from there. So the highest earners have to pay the highest tax and then the highest tax bracket, but then it scales down from there. I know I've shared information like this before, but again, we've had tax rates as high as 94% for anyone earning over $200,000. Now, that was in the 1940s when the tax rate was that high, but just prior to it being 94%, the tax rate was 88%. And then later, after the 94%, it lowered down a little bit, but it stayed at 91% for 12 years for anyone making over $400,000. And again, scales down from there. So for 23 years, the highest tax rate was over 80% for our high income earners. And I don't have the details on all the scales that scale down from there, but I'm sure it still wasn't pretty. I did look up the tax brackets for 1944 just to see what they were for that year for people that were married filing jointly. And the lowest tax bracket for anyone earning $0 to $2,000 was 23%. So that's what I mean when I'm saying, the highest number is for the highest earners, but still not great for those in the lower income either because it scales down from there. And some people will say, well, I'll be in a lower tax bracket at the time I retire. But will you? It's possible. But unless you have all your savings dollars in tax-free vehicles, then that means your income is going to be lower in retirement. So you haven't maybe planned very well, or you haven't built up enough savings because your income is lower in retirement. And we don't want it to be lower in retirement because statistics have shown that people need 100% of their income in retirement, or the money that they were earning in retirement, at the same as what they were earning before they retired. So people that retire tend to need the same amount of money in retirement. And actually, it's higher than that. But I'll just give the benefit of the doubt and say just 100% of what you were earning. Because the expenses are unknown. You don't know if you're going to need an expensive surgery. You don't know what your medical expenses are going to be or your medical insurance costs. You don't know if you're going to need assisted living. And I'm sure you don't want to just be sitting around all the time. You're going to want to go out and enjoy life, get into your hobby, which maybe it's something like golf. That's kind of expensive. Or maybe you want to travel. And so the expenses in retirement tend to need the same amount of income in retirement that you had before you retired. And so you don't want to have less income in retirement just altogether, because that might make a more difficult time in retirement. Your retirement years might be more difficult with less income for the unexpected, unknown costs that'll be coming your way, or just for things that you would like to do in your retirement years. However, regardless of your income, whether it's lower or higher or whatever it ends up being, remember that Uncle Sam can raise the tax rate whenever he needs more money. So you could be in the same income tax bracket, or you could drop down, you could have less income than you did when you were working, and Uncle Sam might raise the tax rates because our country just simply needs more money for whatever it is that we're doing or providing for people. And so maybe your tax bracket actually stays the same, even though you are earning less money, or maybe your tax bracket is even higher than what you were expecting. Now, let's switch gears a little bit and go back to our retirement account and consider the fees. So of course, when you have any kind of account in the market, there's going to be fees involved. If you're working with an advisor, there's going to be fees for the advisor because the advisor has to get paid. We like to get paid for our work. And of course, there are also fees for the investment. So these fees will differ depending on who you're working with and what investments that you have. I would say a common fee for most advisors is around 1%. Sometimes the fee is a little higher. And when your account is lower, the fees tend to be higher because there's not a lot of assets there. The more assets you have, then the fee tends to go down. So let's just say it's around 1% for that. And then also there are fees to the investments, the different mutual funds or whatever it is that you have in your account. So let's just assume a fee of 1.5%. Could be higher, could be a little bit lower. But let's assume a 1.5% fee for the investments and that you are in a 35% tax bracket. So with that information, what you'd be paying on your $100,000 is $525 a year on the government's portion of your retirement account. So you are paying fees to an advisor to manage the money, to manage the portion of money that will never belong to you. That's not your money. Money that will not be going to your beneficiaries or your loved ones, but to Uncle Sam. And for the fees that you are paying when you pass, you certainly won't be leaving more money than is in your account, as you would be in a whole life insurance policy. Instead, you will be leaving the balance of your account minus the taxes that are due. And if you were to pass away and leave your IRA to your children, they will have to deplete that account within 10 years. They can't keep growing it for their own future. Uncle Sam wants his money, and he's been waiting a long time. He does not want to wait now until your children are in their retirement years. He's been waiting much too long. Now, there is some more detail around that requirement. For some who inherit that type of retirement account, they have to deplete it within 10 years and also every single year until it's fully depleted in the 10th year. And I'd be happy to explain this and go over this more if you have this type of account and you would like to work together. Okay, so now let's assume your fee on that $100,000, let's just say it was 2%. Maybe your advisor charges more, maybe your account is smaller, maybe the expenses on the investments are higher. That would mean on the same $100,000, a fee of $700 a year on the government's share of your money. Now, let's say you have a large account. Let's multiply that times 10. And now you're paying $7,000 a year in fees on money that will never belong to you. And of course, this is only 35% of the fee. So you're paying another roughly $1,300 a year on the funds that do belong to you in this example. In addition, you are paying fees for a savings vehicle that penalizes you for all but 13 and a half years of your life to touch your own money. You're penalized at 10% to touch your own money prior to age 59 and a half, and you're penalized at a higher amount, 25%, if you don't start drawing down your account at the rate you are instructed to by the government after age 73. I have some clients who are required to take their distribution, the RMD, it's called, required minimum distribution, and they don't want to. They would rather save that money for the future because they don't have a need for it right now. They are more concerned about higher expenses later, inflation, or just simply needing more money in the future. Maybe they'll need assisted living or something, but they can't keep it in that account. They must withdraw it at the rate that they are told, dwindling down their nest egg when they are more concerned about saving for future expenses. Or maybe you just want to leave it to your loved ones. Nope, no can do. You must start depleting it. So just another win for whole life and the infinite banking concept. You have full control over the funds, how and when and if you pay back those funds without any fees or penalties. Always remember that it's important to replenish the money that you borrow so that it's there to use again, and then you can recycle those funds and use them again and again, and that they are there for your retirement years, rather than just taking the money all the time, taking as many loans as you can, never paying it back, and cannibalizing your policy. But still, it's your choice. It's your choice of what you're going to do, and you won't be penalized, and there is a way to access the cash value income tax-free. So if you're feeling inspired to diversify your dollars and you want to do so by opening a whole life policy, and if you would like to work together, feel free to reach out to me. As always, you can reach me at Valerie@alphaomegawealth.com. Thanks so much for listening into the show today. I appreciate you. Have a great week.
This is thepodcastfactory.com.